Joining us here at Post 9 today, Invesco's Brian Levitt and RBC Capital Markets Head of Derivatives Strategy, Amy Wu-Silverman. It's great to have you both, guys.
It's great to be here.
Amy, let me just start with you, just to put a coda on yesterday and the role that closing hedges played. Can you explain what you think happened?
Sure. Especially around big events like CPI, we've seen a lot of hedge monetization and we've seen a lot of options being opened. We both saw people who own put options closing those put options. We also saw people initiating calls in indices. And essentially what happens is the dealer on the other side ultimately has to buy shares as part of their dynamic delta hedge. And on a short-term basis, that can really contribute in high volume environments to kind of incremental inflection points in the market. And that's what we saw around midday yesterday.
So, Brian, does it mean anything for at least the medium term in terms of the trajectory of equities?
I think it does for the medium term. I think in the near term, we still have challenges. We're still in a contraction environment, so the economy is pointing to below trend and decelerating. Usually in that environment, you're easing policy. We're still tightening, and we're still attempting to figure out the terminal rate on Fed funds. So that creates some near-term challenges. But I guess it depends how we define intermediate term. If we're talking 6 months, a year, 2 years, that should represent a pretty good hold period for investors. Typically, when inflation comes down, once it's peaked and starts to come down, equities tend to do well. So near-term challenges around still policy uncertainty, hard to believe we're still saying it. But if you're a long-term investor, there's going to be some pretty good buying opportunities forming in here.
Okay, so near-term challenges, how do you balance those against midterm elections? And I ask that because I know you've written some reports on what the market tends to do on the heels of that.
Yeah, the market actually, since you can go back to Eisenhower, the market's always done well in year 3, whether or not the president's party loses seats or not. I don't know if that's a coincidence, but year 2 tends to be worse. Year 3 tends to be better. It removes one uncertainty from the market. I think the most likely outcome you get here is some sort of divided government. I'm not here to predict what the House or Senate's going to do, but it still seems most likely to have divided government. In an inflationary environment, markets probably like that because it means not a lot more gets done, similar to what we saw in the UK. We don't want more stimulus in an inflationary environment. So it's just one uncertainty that gets removed as we head into next year.
Okay. Amy, you just laid out some of the trading technicals that were at play in the market yesterday and that massive midday reversal we saw for the major averages. What is the options market? What is positioning there telling you about the future now?
So look, the options market and volatility in general remains quite high. And it's also inverted, meaning the short term is higher than the longer term. And that shows worry and essentially saying we're kind of going to expect this plus or minus 2% move per day. But what I will tell you is in focus now is really earnings. And I think you're going to see a decline in some of the macro correlations we've seen as people focus on idiosyncratic risks. And we're already seeing investors start to focus their option trading on single names. We saw in financials, call spreads trading, essentially betting for upside with so much of the financials portion reporting in the next few weeks. And I think that'll slowly move into mega cap tech and energy as we get onto kind of the onslaught of earnings in the next few weeks.
That's a great point, especially after half a dozen banks reported this morning. Are we in some kind of sweet spot where net interest income is good, delinquencies haven't hit yet? I mean, how long is that runway, I guess?
Well, for one, the banks are better capitalized than they've been. So we're in far better shape than we've been heading into past recessions. But you should expect in an economic downturn, in an earnings recession, the more cyclical parts of the market, the banks will come under some pressure. If you look in aggregate, the market's priced in a lot of the interest rate adjustment. You've seen a pretty big valuation adjustment. We probably still have some room to go on earnings. But then it depends what multiple are you willing to pay. Right? If earnings find themselves at 180 and you're willing to pay a 20 multiple, then we're at fair value. If rates and inflation remain elevated and valuations have to come down a bit, then we've got a little bit more downside on these markets. But again, I'll come back to look at where yields are in investment-grade corporate and high yield. Look at where forward valuations are on equities. Starts to create opportunity.
You mentioned earlier terminal rate. What is your guess? What's the house view right now?
Yeah, I mean, should the third time be a charm for the market? First it was 4, then 4.5,
yes,
now 5.
Yes.
I suspect we're probably looking somewhere around 4.5, 4.75 as a terminal rate. Typically, you would see the Fed funds get up above the year-on-year percent change in core PCE. I think you're around 4.9. So maybe we meet somewhere around there. And maybe the market got a little bit of a reprieve, a respite yesterday, because I think we're starting to get the sense that maybe we're getting short rates to somewhere close to what the terminal rate is going to be. Once 2-year rates peak, that's when risk taking starts.
Amy, I want to get your thoughts on this as well, especially since when I read your notes, there's talk about the pain trade is now most definitely to the upside.
Yeah, you know, we focus a lot on kind of the tactical positioning, especially with most liquid options trading in the 1 to 3 month period. And I'll tell you, we went from a point earlier this year where people were not well hedged to a point where people have either become well hedged or they're in cash. And essentially, you create this situation where there's going to be FOMO if we start to see something that builds on itself in terms of positive momentum. And that's why I think in the market now, on days like yesterday, for instance, you start to see these very out of the money calls being owned in indices, especially in your kind of long duration assets. And part of the reason for that is people do consider that a hedge. It's simply just an upside hedge. And so I think that's how people stay with their toe in the market, even though I think net the sentiment in the options market remains very bearish. You start to see people say, look, with volatility at these levels, is that an attractive yield as well in comparison to what we're seeing in rates and what we're seeing in cash? And certainly that rate suppression, what has happened for the last 10 years, is moving the other way, where we're now finally seeing volatility flow back, not only into equity volatility, but kind of cross-asset volatility as a whole.
Right. Yep. Generations having to learn, go far back, read some history books about what life used to be like. Thanks, guys. Good weekend.
Thank you.